14 practice number 7. My video ended abruptly, sorry. Federal Semiconductors issued 11% bonds dated January 1st with a face amount of $800 million on January 1st, 2018. The bonds sold for $739,814,813. So that's the carrying value. They mature on December 31st, 2037, 20 years. For bonds of similar risk and maturity, the market yield was 12%. Interest is paid semi-annually. And we're going to determine the fair value, to report these bonds at fair value, and they gave us the fair value amount. So, in the first one, we have to calculate the cash interest paid and the bond interest. So on my Excel spreadsheet, interest expense is calculated at 6%. Again, 12% is the market rate times the carrying value, but 12% divided by 2. So that comes out to $44,388,889. That's the bond expense, interest expense, $44,388,889. The cash interest paid is always going to be the face amount times the face value, face interest. Interest on these bonds was 11%, therefore divided by 2 is 5.5, and the face amount is $800 million. Therefore, the cash paid is always going to be $44 million. Again, that's not going to change, so you can put that on the next one as well. Okay, so the difference, the increase, what happens is the difference between the expense, the interest, and the cash paid is going to increase the value, or increase the carrying value. So you'll notice this $388,000 went and increased the carrying value. For December 31st, again, we have interest expense, but now we have to base it on the new carrying value, which is the addition of that amount. So 6%, so this comes out to $44,412,222. Again, that amount is added, $412,222 is added, and now we have a new carrying value of $740,615,924. We have to compare that to the fair value, which means we have an unrealized holding gain of the difference, $10,615,924. I do show this on the Excel so that you can see we started with a book value of the $739 million. We added $801,111, again by the 2. Therefore, we have a new book value. When we compare that to the fair value, this is where we get the fair value adjustment and the amount that we need, the $10,615,924. So, back to our spreadsheet here. We are going to have to do the next let's do the 6/30 of 2019. Okay, so if we go down, and this is number 2, June 30th of 2019, we have interest expense, again, based on the new carrying value. So we're going to have $44,436,955. So that amount goes here, $44,436,955. Therefore, we have, again, an increase in balance of $436,955. Our next interest payment is December 31st, again shown on number 2. Again, 6% times the new carrying value, we get $44,463,173. So now we have a new carrying value of $741,516,052, and we have a fair value of $736 million. Therefore, we have to do the difference between these two. Again, we have an unrealized holding gain of $5,516,052. This all ends up calculating for you, just to show you how it come to the fair value adjustment. So you had 10 million as your adjustment, and now because of the new adjustment, because of the increase in the carrying value, the fair value adjustment went down, which means we have to do a journal entry to decrease that fair value adjustment. Okay? So this all populates for you based on what you put above. So the journal entries are what we did this all for. We did it so that we could do the journal entries each time. So on June 30th, 2018, we're going to have interest expense. We're going to have discount on bonds payable. And of course, we're going to have cash. Cash is always going to be $44 million. Again, if you go back to my spreadsheet, you'll notice this is the first entry. Interest expense is going to be $44,388,889. The discount is going to be the difference, which is going to be $388,889. The next entry is the December 31st. Again, same titles. Interest expense, discount on bonds payable, and of course cash. Cash is going to be $44 million. This is going to be based on the December 31st, so going back to Excel, $44,412,222. Therefore, we have a credit to bonds, discount on bonds payable, $412,222. It's the difference, so the debits equal credit. Number 3, this is recording the fair value adjustment. So we're going to debit fair value adjustment, and we're going to record an unrealized gain, unrealized holding gain, OCI, other comprehensive income. That's the $10,615,924. Again, I showed you this in Excel. It's the difference between the carrying value and the fair market value to get the $10,615,000. We record it as other comprehensive income. And I just wanted to put a note in there that a decrease in the value of an asset is a loss. A decrease in the value of the liability is a gain. Okay? These two numbers will match. Number 4, we're going to record the June 30th, 2019. Again, interest expense, discount on bonds payable, and cash. Cash is always going to be $44 million for this problem anyways. Our new interest for June 30th of 2019 is $44,436,955. Therefore, our discount is going to be $436,955. Number 5 is the December 31st. Again, interest expense, discount on bonds payable, cash. This is going to be $44 million. This is calculated using the new carrying value. So on December 31st, we're going to have $44,463,173. Discount is going to be the difference. Our last entry is again to do the fair value. So the feds determined that 1/2 of the increase in fair value was due to a decline in interest rates. Therefore, when we go to this problem in Excel, we find out again that the difference, we already found that out based on our original chart, but our change in fair value is $5,099,872. Because the change, half of it, so the 736 minus the 6 million difference, 736 million minus the 730 million is $3 million. And because of that change is due to a change in interest rates, we can assume that the remaining change in fair value is a result of credit risk. Any change in fair value caused by a change in credit risk is reported as Any change in fair value caused by a change in the credit risk associated with securities is reported as other comprehensive income in the statement of comprehensive income. So therefore, we have a loss, OCI, of the difference, $2,099,872, and the $3 million is going to just go to unrealized holding loss, NI, net income. So our entry is going to look like this. We're going to have unrealized holding loss, NI, and an unrealized holding loss, OCI. OCI is the difference. So this is the $3 million, and this one is the difference between the total fair value adjustment, which is our credit, $5,099,872. Therefore, the difference between these two, $2,099,872, is the amount goes under other comprehensive income. The first one is the NI, unrealized holding loss, NI. That's it for number 7, chapter 14 practice.